Hello, everybody. Kirk Spano on December 16th, 2023 with Scott Shooter Henderson, and we're going to cover our major markets. How are you doing today, Scott?
Hey, I'm doing great, buddy. How are you?
I am good. I am almost over my 9 bowls of gumbo in 5 days, and I'm ready to make more.
Oh, that would have killed me. Yeah. It was good to meet you too, by the way.
Yeah. Everybody, Shooter and I met in Houston when I was there on another piece of business, and I got to talk about a lot of things, including what's coming in 2024. We talked about Bitcoin, we talked about the space stocks. So he'll be writing a primary waves on the space stocks basket. Is that for this week?
Yes.
It is. Okay. So we'll have some very interesting space stocks for all you out there who want to try to get stocks that go to the moon. I think we got a few. So major markets. Let's talk about the dollar.
So we'll talk about some rejection at that 8-day, huh?
Yeah.
It looks like we're heading towards that 99. Yeah, I think we stay in this band again right here, the high side of that prior risk off up here from that 101.87. I think we stay on the high side of that band from 100 to 101 range for a little while.
Right. I like that band as my long-term magnet for the millennial dollar.
Yeah.
So,
and we could get a good bounce if we get back down, because I look at this as drive 1, drive 2. So if we get down and put that 3 in, that's a reverse 3 drive, which would put us back up here at 110. So, I mean, it really depends on how it plays out here. There's a number of things on the map, but at the moment, this is definitely a tailwind for indices and stocks.
Okay. So let me ask a question. My thesis is that liquidity, well, we know that liquidity has gotten a little tighter lately, mainly driven by QT and people taking money out of the stock market and just throwing it into money market accounts. But we also know that there's banks that have a $500 billion hole in their balance sheet combined that have to deal with it next year. So because the Fed never waits until the right moment, they always wait until too late. If these banks have a problem and credit gets tighter and liquidity gets tighter, that would be the thing that drives the dollar up, probably, right?
Yeah.
And then that would drive stocks and real estate down. But then if the Fed turns around and loosens and lowers rates like we think they're going to do with a special facility for the banks, don't call it QE, but also ending QT potentially, or at least reducing it, then you have the downtrend in the dollar resuming, and that purple band is where we could ultimately get to over time.
Yeah. Well, what was our point of our lowest rates?
Well, I guess that was, during COVID.
Yeah. So, this is COVID.
Okay.
So, we went through this, period right afterwards, which I look at it as an anomaly. But if we go back a little bit in time, there's actually a very large band, which I don't have on here, from this B to this A. So from that 96 down to 82, basically we stayed in that band from 2015 really through 2021.
Okay.
And then when the Fed tightened, this is when this leg started. So that entire thing should unravel, which is what the chart tells us.
So let me ask a question for the novice technician here. Those 3 bands, you have the 2 pink ones kind of up on top and the purple one at the bottom. That basically defines the range which we expect to be in. It can go outside, but those seem like kind of the top end of the range, the bottom end of the range, and then the magnet in the middle. Is that a good way to understand that?
Well, it's when you have an overbought status, you have what's called buyer exhaustion. When you have an oversold status, you have seller exhaustion. And really, that's what those bands measure for me. We're looking at a weekly chart. So these are weekly candles. The close of the candle is where I measure from to the peak. So from the peak to the close is what it measures. So, like, for example, let's get one I can pop. This January 2017, the high is 96. The low is 94. The close is 95.36. And, that's what I'm most interested in, because that's where the buyers and sellers at the end of that close on that weekly have settled on price. And it is the most likely place that floor traders are going to be positioning themselves. So, and that's pretty much across the board. So that's why I track it. And I found it to be a significant correlation in Elliott wave in helping me pick tops and bottoms. So that's what that measures.
Okay. All right. So what does that impact? What do the rest of the markets look like?
Well, if you're not all on board, get on board. Because I think we extend, looking at the counts. I really do. I mean, we're just no reprieve. We should have gotten a pullback at least to the breakout line Friday. We didn't get it. So even if they were repositioning, which we clearly could see they started late Wednesday and early Thursday morning repositioning. So, I think this 3 could push up to about here, maybe a little more, because of our length of our wave 1. So our primary wave 1 here is this distance, and wave 3 is the longest wave. So I mean, we have the potential of some significant upside, or this plays out as an ending diagonal, which is what the count suggests at this point, which basically is a broader wave 2 and a slenderer wave 4. So it's suggesting it's a leading diagonal. However, it's more impulsive to me when I look back at other impulsive legs. All right.
All right.
All right, let's take a look at the NASDAQ. We're getting toppy here, and, our range tightened up. We didn't quite put in an inside week last week, but it still looks flaggy to me. I mean, we've got what I refer to as an extended pole, and then we're sort of building out this flag here. So as long as that flag continues to build out, we don't go below this low on, 434, which, 400 obviously is a psychological price point. So I think 400 holds. And then we get our jet fuel up to wave 3. But again, this is the same scenario. Wave 1 is this long. Wave 3 typically is the longest wave. So there really is nothing that would prohibit that to extend to either.
All right. So a wall of money hitting the stock market at some point could really pull this up too.
Another significant factor is where RSI is. Now, granted, our first leg, I look at this as mound. Let me come out to the weekly to give you a better visual on this. But, we have these mounds that occur, so this really is drive 1. We're building out drive 2 up here. So drive 3 is going to be way the heck up there. I mean, drive 3 is up well over 600, which the count doesn't even see yet. But structurally, from a longer term outlook, the NASDAQ or tech, because actually we should call the NASDAQ the tech stocks, really has the potential to, I think AI pushes us over the edge. We have that new industrial revolution, but in AI. That's my thought.
Yeah. Can you show the 1 month?
Yeah. Hopefully it's clean.
So we're not even close to being overbought on the monthly.
No. We're not even above 70.
Yeah.
We got a little basing pattern here. I mean, it's, it's high and tight, which is good. That usually indicates that it's there. It's going to stick, because basically you have that euphoric. We had a decent close on this candle. So our close was 277 with a low of 254. So nice range, closed on the top of the candle, which to me is always bullish, or closing on the bottom of the candle, it's always bearish.
Yeah. I really think we can see a euphoric rally here. I don't know if it comes after a little pullback and then the special facility, don't call it QE at some point.
Realize our breakout is right here too. I mean, right at our 8-day.
Yeah.
I mean, we're not there. I mean, we haven't gotten the breakout, which is where the money comes in. So, like even since the last time I looked at this chart, which probably monthly was probably Wednesday, the count, I just moved my target 1 up because the count's pushing. So usually when the count pushes, it pushes 2 or 3 times. So, again, that 3 probably going to push again, and it'll probably push again until we get up to that 61.8, which is a good spot relative to, the history of the tape.
Yeah. And 500 is, it's
I think it's on deck. I really do.
Right there.
I mean, we need a catalyst that's not positive to really change that outcome at this point. Just realize I your comments about money on the sideline, and some of the Goldman Sachs boys and even Bank of America, the folks that I have sort of near with, they think there's about $6 trillion on the sideline that's going to come in after the first of the year. So either we get a flat and nobody's ready to move yet, and they're waiting to see what the market does the first week, that kind of thing, which is, I think it's about a 50-50 likelihood, or the gates open when we're back trading after the first of the year. Right now, what we saw going into Opdex, realize this was the largest options expiration date in history that occurred Friday.
Right. And the world didn't fall apart.
No, it didn't. We didn't correct anywhere near what we should have. I mean, it was just, to me, it was extremely bullish. And, I'm sitting here looking at what positions I have on long, and I'm like, man, I never have enough on. Never.
Yeah.
So that's my thought. But let's jump over and look at the Russells. Now, the Russells, nice gap, but I think that gap gets filled before we keep going. But I've also raised the counts up on that as well. And now I know you don't like to look at the Dow, but I want to jump back to the Dow for a second. And this is more I want you to see the breadth of the move in the Russells. Okay.
Okay.
And then I want you to see the breadth of the move in the Dow. Okay. And then the breadth of the move on the NASDAQ, right? The breadth of the move on the SPY. So SPY is leading, the NASDAQ is behind, the Russells is in third, and the Dow is the leader as far as the move. So what you're seeing between the four indices is that breadth is continuing to expand.
Right.
So
and we had the breadth discussion 2 years ago. Right. And everybody said, well, breadth is expanding. Well, at some point, it can't expand anymore.
Right.
And that's when you get your reversal.
Yeah, I think that's when the Dow gets up to 390. That's why it's so important to me as far as looking at it. Make sense?
Yep.
Okay. So let's take a look at TLT. And nice move here. I question whether we get, the count has pushed a little bit lower. I had 97. Well, I did a quick little article on it, but after I looked at it today, it gave me a new count of 96, 93.
Okay.
The downside. So that's your next entry long if we get there. And I'm gonna repeat that. If we get there.
Right.
This has been a very euphoric move considering the history of the tape, and we have never seen that much volume going into the 20.
Right. So
at least TLT, never.
3 weeks ago we talked about this when it was right at that bottom.
Yep.
Coming off that bottom, and
yeah,
you were saying, well, if there's a retrace, it'll get retest the purple bar.
Yeah.
And I was like, but what if everybody thinks that rates are going down next year and it rallies?
Yeah.
So my suggestion was you start trimming it around 110, 112. But it looks like you might even be able to wait until the teens to trim. Is that what that looks like to you up there?
Let me jump out to the weekly to give you a visual. If this back test, realize where our breakout line is up there quite a little bit there. That is at 109. So that's where the move starts. This is just kindergarten, to be candid with you. I mean, that's really what it is.
So I mean, it gets the 109, jitterbugs around, then the next stop is 120.
The next stop is going to be how far quick it slices through. Realize the real support band that we took out for the highs is up here around 132.
Yeah.
So, and then back towards our high. Realize this is
right.
The last time the Fed was easy.
Right. So now the Federal Reserve in their last statement said, look, and this has been out there and developing, that they think that the neutral interest rate is just a hair under 3%. And to go below 3%, that would be, your next crisis. I don't see a crisis until the baby boomers really are all on Medicare, which is 2029.
I mean, jobs are good. Data's good. We're not in bad shape at all.
Yeah, AI isn't going to take a lot of jobs. It's just going to make a lot of jobs more productive.
Well, I think we become more efficient. I mean, I'll use me as a prime example.
Yeah.
It's streamlined some of my efforts of looking at things. I mean, substantially, just in the books. I've read 9 books. Well, I haven't read 9 books. I've used 9 summaries of books, asked the questions that I wanted to ask about the books. 10 minutes, 15 minutes later, I'm done with the book. So it's like, I think that's the greatest thing since sliced bread. It's no more 4 or 5 hours reading the book.
Right. Right.
But let me show you one thing here that I like to look back in the history of the tape to give me a visual of the move. So we know this is our likely move, right? So I'm just going to steal this.
Well, but that's if rates go back to 0.
No, I think that's rates going back to 1 or 2%, because realize that's only 50% back. I don't, let me put my fib tool up here. That's, to me, I if we start that new uptrend, I'm just going to measure this leg to our low. Just realize we are way oversold. I mean, way oversold for really what happened. It was like Armageddon was coming, So, 50% back to me is going to put us at least at 116, but we get above that 78.6 it opens up this next box around 180, that 150% back up here. I mean, because now, and that is consistent with my study of how drive 1 and drive 2 works. Okay. So drive 1 was our high here around 179, right? So drive 2 is just a little bit of an overshoot usually. So it's just a little, it gives us a smudge of a new high, right? So I would say that the likelihood is that we ultimately put in a little higher high than this January of 2020 high at a 2% rate.
Wow. Okay. Well, we'll see. I don't foresee rates getting as low as they got during COVID. However, this chart will end up playing out the way people think it's going to play out, at least for a minute, versus maybe where rates actually go. This is a 20-year based on 20-year rates. So, what did the 20-year get down to during COVID? Was it right around 3% on the 20-year, but the Fed funds rate was 0. Can people believe at some point that long-term rates need to be around 3%? And if they do, they believe it. Whether they get there or not, if they believe it, this chart's going to move the way that you just said. Am I thinking about that right?
I think I don't want to use the word quagmire, but I mean, realize the government has a lot of debt. The higher the Fed funds rate is, the more interest they have to pay. So either we debase the currency to the extreme, which is going to happen to some degree no matter what, because that's ultimately how we've papered over prior, crash cycles. We have to absorb all those losses. Every single one of them.
Right. We just debase less than everybody else.
Right. Okay.
Which is why the dollar stays strong.
Right. But at the same time, we also are in a situation where our tax rolls aren't growing, at least with the current policy, at the extremes we need, because right now, I don't want to use the term the Fed's in trouble, but we're not in the perfect position when it comes down to our debt. That needs to get resolved. So the quickest way for them to resolve that is reduce the interest burden on the debt. Right. So I think it's more likely the Fed overshoots to the downside this time because nothing happened last time. And they're going to do that because of the necessity. And you even look at the bond auctions that have, treasury auctions that have gone on. We've had a number of lackluster sales on both short-term and long-term debt. Okay. And right now I'm not recalling the exact figure that we needed, but we needed like 1.3 or 1.2 trillion dollars to be sold by January 1. I don't think we're there. So, I mean, that's going to carry over into the first and second quarter if they haven't sold it at this point. So I think there's a greater shot that they overshoot. That's just my 2 cents.
Okay. I mean, because it's going to take a while for tax policy to be what it should be.
Yeah. I don't think it's quick enough. I think a quicker reduction of rates is the fastest way for them to get there.
Right, because in the short run, all you can try to do is bend the growth curve down on spending. You can't really spend less. I mean, people who say that just don't get it.
Yeah,
there's nothing to cut.
Yeah, and this volume tells me somebody knows. Right. The one thing that I've learned more than anything else in this market is somebody always knows.
Yeah,
it doesn't mean they're trading it, but they know. So. Right. Well, and they said it's something at Thanksgiving to the brother-in-law who works for Goldman Sachs, for example, or manages a fund, right? And of course, he's all ears, or she's all ears, Right. But see, to me, I look for tells inside the tape, things that are telling me something different is going on here. Somebody thinks the Fed is going to be very reactive here to cutting rates. That's what this tells me.
So let me ask a question. You tell me if this makes sense. And this is the thing that somebody might know if, they hung out with both political parties and talked to hedge funds all over the country, something like that. Let's suppose that the interest on the debt has risen to 14% of the budget. Mm-hmm. And that the deficit every year is still only between 5 and 7%, heading towards 5 from 7.
Right.
So if you have a 5% deficit, but it's 14 of those points are because of interest. If you cut the interest by 5 points, right? So that'd be cutting the interest almost in half. Suddenly you have an almost balanced budget.
Yes.
So that's why I don't think people understand is that simply a manipulation of interest rates can pull the deficit almost to like nothing. They can almost balance the budget just by having super low interest rates. The problem with super low interest rates, as we found out, is that when you combine that with a supply shortage, you get inflation. So what if the supply shortage is gone, right? What if we get rid of all the supply shortages and that's not going to happen again? Could we have lower interest rates for longer, even though they just told us higher for longer? Could we have low interest rates until, I don't know, a long time? Let's just say a long time.
Look at Japan. I mean, what they did it 40 years, whatever it is.
Yep, 40 years.
Yeah.
I mean,
so it's you know, I mean, we're outside the box. I mean, we're in, you know, we're in a period of discovery here where we are with financial structure for the government, because we really don't have anything to look back in history except for Japan. And you know, I think the Fed did a fantastic job here, you know, dealing with, you know, because COVID was such an anomaly. And, you know, we probably would be in a depression right now if they hadn't reacted the way that they did, because they had so much to paper over. I mean, it's just.
Can you please restate that? The Fed did a what?
A wonderful job. And
they did do a good job. And everybody wants to say how dumb they are.
Yeah,
I agree with you. They kept us out of a depression.
Yeah, yeah. Well, they actually kept us out of a global depression.
Yeah.
I mean, now does I mean, China's in, I mean, deep trouble right now. I mean, their banks are. So you know, I want to go into emerging markets because of what the tape tells me. But
yeah,
the micro events that are going on over there, it looks to me like it falls apart over there. So, you know, you know, very often does a financial crisis come from within the United States. So
right.
That's, you know, I always am looking at what, you know, it's just like the Ukrainian war. It's a potential catalyst. It's still a potential catalyst. You know, from day one, even before it occurred, there was a catalyst because it was a potential outcome. So looking at China and the financial markets, our biggest problem is that there's so much dollar-denominated debt that came out of China for their internal construction programs that's something you know, that actually is beyond my pay grade. I really don't I wish I understood that better, but it's such a large beast over there. It's like 120 trillion dollars in derivative debt that was
should we introduce a new conspiracy theory segment?
I mean,
conspiracy theories.
Yeah. it's you know, I really don't look at it from I'm looking for the catalyst. I want to know where potentially an event's going to come.
That's not where I was going with that, though.
Okay.
I was going to say the Chinese need to balance their budget. The Chinese are afraid of all the old people that they can't pay for. The Chinese somehow released a disease that kills old people. And now they're about to embark on 40 years of quantitative easing.
Yeah. Yeah. The problem is that they're not as liquid. I mean, they can print money, right? But they don't have the internal GDP. And that's one reason, you know, all of a sudden we had no meetings with China, right? Now all of a sudden we got a slew of people meeting with China. The reason being is they know they're in trouble. And the only thing that's going to help them recover is us.
Yep.
So, you know, and obviously I do think some kind of deal comes out of China where, you know, our relationship is smoothed over, but that's just going to be more of a tailwind. So I think that's the most likely outcome. However, I'm like I always am. I'm overly cautious. I want to understand where my black swans potentially are, so I can risk adjust to those circumstances. Because, you know, basically what I'm saying is I don't want to be 8 or 10% into emerging market, maybe South America, you know, maybe India, you know, but I don't really want much exposure in China, even though, you know, like some of the stocks were doing great this week. You know, it's where I would rather go to something where I have more confidence, where I don't have those types of events. Make sense?
Yes. Are you able to put up the Japanese stock market for like a long-term chart, a 50-year chart? I don't even know what the symbol is.
Neither do I. Hopefully it comes up when I
NKE.
Nikki.
The Japanese stock market. The reason I asked, there it is. All right. The reason that I asked about Japan is that when you take a look at it over a very long time period, like pull it all the way back to about 1975, you know, 50-year chart.
Yeah, it only gives me 2006.
Okay, well,
Let me see.
it's not a horrible chart in the last decade, is it? My point is that Japan did 40 years of quantitative easing, mainly tied to major industrial economic transitions and aging demographics. So when you take a look at Japan, it took them 2 generations to break out. I don't think it'll take the United States that long because we're the reserve currency. We are the biggest producer on the planet. We're the biggest consumer on the planet. We have the biggest military on the planet. Everybody looks to us. So all the things that happened in Japan over 40 years, I think began here from the financial crisis, and I think will only take 20 years, maybe 1 generation, maybe 15 years. So if it's only a 15 to 20 year thing, well, count backwards starting from 2008, and what you see is that we're in that 15 to 20 year window where we could have a mega rally that looks like what Japan did in the last decade, but steeper to the upside. So if earnings just keep going up and multiples don't contract to match 50 years and 100 years ago, and multiples are going to be higher in the QE era, which makes sense, that means that we could get a huge breakout at some point to the US markets, and there will be major corrections in there. And ultimately, over 20 years, it might end up being kind of range bound plus inflation, right? Because stocks will still make what inflation makes, but you might get a massive rally, a collapse, a massive rally, a collapse, and then another massive rally. So even though I see the S&P 500 getting to 600 relatively soon, maybe it doesn't get much higher than that. And maybe it does come all the way back to 300 or 400 a couple of times.
It could have a correction. And I'm just gonna, that brings us back to our original trend support. I mean, today it could have a correction back to 266, and it has not invalidated the uptrend,
right,
from where we are now.
So, and that's why I think in a general uptrend that exhibits choppiness, people who can be good position traders, right? You don't have to trade as often as Shooter folks, but, because you don't have to scalp and do all the things he does. But if you keep an eye on these major moves to the top of trend ranges and then back down towards the bottom of trend ranges, which takes quarters and years usually, that's the amount of asset allocation management that you need to do. So when everybody is telling you it's going to go to the moon because it just went up 30% and it's at the top of a trading range, that's when you should say, I'm going to keep my principal in the market, but I'm going to take all my profits out. And then when the stock market comes down and everybody tells you, hey, it's all going to hell, it's down 30%, you say, oh, well, I got this money in the bank. I think I'll start buying this stuff that you hate now. And that's how I've always done it for over 25 years now, is I just deal with the tops and bottoms of the longer term trends, hence fundamental trends, and you generally will do pretty well. I was able to sell in 1999, and then I was able to buy in 2002. I was able to sell in 2007 and 8, and that was kind of semi-famous because I was buying people dinners telling them to sell, and they told me I didn't know what I was talking about. I told everybody to sell almost everything right before COVID, and then we got super long eventually. I didn't quite understand that the Fed was going to do such a great job, right? Because the bias is that they won't, but they did a great job. So now, well, everybody doubts the Fed. What if they're actually pretty good at their job? They understand what we've been talking about. I'm guessing they do. And that's that the Federal Reserve balance sheet doesn't matter that much. It can grow to 10 or 20 trillion dollars. It just doesn't matter. As long as they finance the debt through the millennials, we're going to be fine. Well, the millennials aren't going to die for 50 or 60 or 70 more years. I think that the long-term uptrend in the stock market is safe for the rest of the century. I think that there will be huge corrections along the way. I think it's going to be a lot of what we've seen for the last 70 years, for the next 70 years. Remember the most dangerous words in investing. What are they, Shooter? Do you remember? It's different this time.
Yeah.
It's not. It's just not. So if you understand that the markets will continue to progress in fits, in leaps, and the euphoria and the depression right? People will be so happy and then they'll be so sad. If you can manage your emotions and just understand kind of the same old, which is why Elliott Wave has a lot of validity. You know, people say, well, Elliott Wave got it wrong. No, Elliott Wave is just telling you that there's patterns, and the big patterns are usually pretty right. The smaller you get, they're pretty right again. In between, it's hard because why? The middle of the market is hard. But Elliott Wave shows you a big picture. And then as you get close to inflection points or pivot points, which is what Paul Tudor Jones always talks about, and he's one of the greatest investors and traders ever. He's the guy who caught the pivot on 1987. You start to realize that if you ignore the middle of the market, right? Shooter trades the middle of the market. That's too hard for me.
It's a lot of work.
It's a lot of work. And that's why people who want to do it like an hour a day, it's not going to happen. You got to have the kind of commitment that Teresa has, where she treats it like a part-time job, and you like a full-time job. So I'm trying to tell people, hey, we can get you most of the way there without you having to trade a lot, because we'll help you with the tops and bottoms of the major moves, and we'll give you stocks that have huge upside. And I think that the space article that you have coming out this week, I think that's a group of stocks that can move a lot because they're beat to heck.
I got some good ones in there, actually. Found a couple new ones.
Oh, great. Yeah, no, I'm super looking forward to it. All right. You get the last word. What's your last word on major markets?
Well, I'm going to say buy any dip.
Buy the dips.
Buy the dips.
It seems like that's worked in the past.
Yes, it has.
Right. All right, everybody. Have a great holiday season. We will be back on the next couple Saturdays. So there won't be any disruption to the Saturday schedule. But the next 2 weeks, well, there is a Monday show this week, but then the 2 weeks after that, no Monday retirement income options because it's holiday time. Ho, ho, ho. Happy New Year. All the other ones. And have a great end of the year, Shooter. It was a pleasure to meet you in person.
I will make it again.
Yeah, I'll make a point of getting to Houston again, or chasing you somewhere in the country if you go to Florida. I mean, if you happen to be in Florida,
up in your neck of the woods, we might go.
Okay, well, if you happen to be in Florida and it happens to be 20 degrees here, I may jump on an airplane. All right, have a great one.
Did I lose you?